Right. Fine. Let's discuss a very important topic for a financial system point of view, economical system point of view. Right. Any nation, wherever you go, the one important concept that is now we are going to discuss. The title of topic is monetary policy. Right. What is monetary policy? Why this policy is that much important for an economical system or a financial system? Who controls this in a particular nation point of view? So what's the importance of this whole topic? Let's discuss in a simple manner. Right. First of all, coming to this topic title, monetary. The meaning of monetary is money. Money policy, right? As we all very much aware of that, for every individual you can say, a family point of view you can say, maintaining money policy is very important thing. In the same manner for a nation also. So that's why this topic, this monetary policy topic, has a very important vital role in a country financial system point of view. So overall monetary policy is nothing but money policy. So now the first question, what is this policy? Who controls it? How it works? All these things let me explain. This policy, monetary policy or money policy is nothing but it is a simple process by which monetary authority of a country, monetary authority of a nation will controls the proper credit flow into the society. So simply it's a process. Monetary policy is a process by which monetary authority of a country controls the proper credit flow into the society. Right. You may ask a question. You ask question, who controls this process in our nation? Right. Remember one thing, in our nation, the total monetary policy is controlled by our authority called Reserve Bank of India. The one who controls the topic in our nation, that concept in our nation is RBI, Reserve Bank of India. Right. What is monetary policy first of all? The simple principle behind this topic, wherever you go, either it is in India or in America or else in some other nation, monetary policy, the simple concept principle is either money expansion or money contraction. That I can say technically monetary policy expansion or I can say monetary policy contraction. Right. Based upon this simple principle, the monetary authority of a nation will control the proper credit flow into the society. So let me conclude one thing from this discussion. What is monetary policy? It's a process by which monetary authority of a nation, monetary authority of a country, in our nation monetary authority is our central bank, that is Reserve Bank of India, which controls the proper credit flow into the society by the simple principle called either monetary policy expansion, that is money expansion to the society, or is money contraction, that is money absorption from the society. That's a simple principle. You could ask a question, why RBI need to do these all actions? Why they need to control? Why they need to inject money? Why they need to absorb money from the society? Again, simply few objectives behind this topic. One, it is maintaining price stability of a nation, prices of goods and services, whatever it may be, so that I can call that simply inflation. Right. So first of all, what is monetary policy clear? Who controls it clear? That is RBI. And next discussion with respect to monetary policy that I have to discuss. What are the objectives behind this topic called monetary policy? The first and foremost important objective behind this topic, maintaining price stability. Maintaining price stability. Other words, I can say control of inflation. Right. The second foremost important objective behind this topic, maintaining financial stability. Why? What's the necessity to maintain stability in a financial system? Because to achieve growth in a proper manner, economical growth, maintaining price stability, maintaining financial stability for the achievement of economical growth for a certain point of view, and these two things we could achieve with the help of other objective, that is advocate or else advocate flow of credit. What is monetary policy clear? Who controls it? RBI. What are the objectives? Price stability, financial stability, and adequate flow of credit. Right. Now let's discuss RBI. That's our authority who controls monetary policy system. How it achieves these objectives? What are the weapons that Reserve Bank of India have their in pocket, what are the weapons that RBI have in their own pocket to achieve these all objectives, right? Yeah. So to achieve those particular objectives, in RBI pocket, Reserve Bank of India have two weapons. I can call direct instruments and indirect instruments. With the help of these two weapons, that's direct instruments and indirect instruments, Reserve Bank of India will achieve the set objectives previously, right? What are direct instruments and why? Let me list out first. What are direct instruments? CRR, SLR, and refinance. These three comes under direct instruments. So we will be in a position to answer why these three I categorized under direct instruments by the end of this discussion, right? Now under indirect instruments, I can classify repo rate, reverse repo rate, MSF, marginal standing facility, bank rate, and like other things, MSS, market stabilization scheme, open market operations, marginal cost of funds based lending rate, MCLR. These are a lot of things that we have to discuss under indirect instruments. Whereas direct instruments, these three. And one more thing, remember, these direct instruments are also called as reserve ratios. Why these are reserve ratios and why I classified these things, we will get clarity in further discussion, right? These are reserve ratios. Let's discuss first of all this direct instruments perspective point of view. What is CRR, what is SLR, what is refinance? Then I will discuss about these indirect instruments. And one more thing, remember, these indirect instruments are also called as policy rates. So simply, reserve ratios or direct instruments, same. Policy rates or indirect instruments, same. So let's discuss first what is CRR, what is SLR, and how these things will achieve our objective. Let me discuss, right? First of all, CRR, nothing but, remember, it's cash reserve. CRR is nothing but cash reserve ratio. What is the definition of CRR? Let me explain in a simple picture manner how a CRR will work. Let me consider a bank, a customer, right? Let me consider this guy as my depositor, bank, depositor, borrower, and bank authorities, as we all know, Reserve Bank of India. How that I could explain with this picture CRR will work, right? Let us assume my depositor with me having an amount of 100 rupee. Their money in different deposits form, savings account, current account, FD, RD, whatever it may be, right? Actually, the combination of those things I can call one more word called NDTL. Net demand time liabilities. Further discussion of NDTL is there, that will continue in other class, right? So what is the meaning of CRR? Some person, this amount, the amount which the banks have in their pocket, which belongs to their customers, in the form of demand deposits, term deposits, that I can call, that is NDTL, net demand and time liabilities. The definition of CRR, cash reserve ratio, is nothing but, it's a percentage share of, CRR is nothing but percentage share of NDTL. Percentage of NDTL. What is NDTL? The NDTL is nothing but the money which belongs to customers. Are this some percentage of money or some portion of money every commercial bank must and should need to deposit with RBI, and that too should be in liquid cash form only. So that's nothing but simply definition of CRR. Cash reserve ratio is nothing but some percentage of money which belongs to customers in bank pocket. This money every bank has to park with RBI in the form of liquid cash. Remember, only in the form of liquid cash. So that is nothing but cash reserve ratio. And one more thing, remember one more thing. On this CRR money, the money which banks deposited with the RBI, on this CRR money, Reserve Bank of India will never pay any interest. It means for a banking system, this CRR, it's a burden, negative kind of thing with respect to this CRR point of view. So from where they will recollect, from there where they will neutralize this thing, all the things from this borrower, whatever the money they are lending here to the borrowers, from these people they are charging some interest, and which will be definitely more than the amount that they are paying to their depositors, right? So simply so in this simple example, let me consider what is customer money, 100 rupee, and I can call this as NDTL for understanding purpose, right? Some percentage of this money, some percentage of this 100, every commercial bank has to park with RBI. That's simply CRR. That's simply cash reserve ratio. And remember one thing, at present the value of CRR is 4% of NDTL. It means what? What is total NDTL? 100. On that 4% means 4 rupee. It means for every 100 rupee, for every 100 amount of NDTL, every commercial bank as a present cash reserve ratio, that is CRR, 4% of that NDTL amount, commercial banks has to park with RBI. In which form? In liquid cash form only. And remember one more thing, for CRR, RBI never pays any interest at all, right? So that's about CRR, and a few important points for examination point of view. All things we should remember. They may ask a lot of times, what is the present CRR value, like that. So it's 4% of what? It's 4% of NDTL, right? And apart from that, one important point with respect to CRR we should remember, this CRR had mentioned under section 42, subsection 1, or I can say subsection A or 1, CRR had mentioned under section 42 of subsection A of this act. RBI Act 1934. Remember the few important points. First of all, what is CRR? Some percentage of NDTL. Every commercial bank has to park with RBI. That's simply nothing but CRR. And at present CRR value is 4%. And remember, this CRR had mentioned under section 42 of section 42 subsection 1 or else A of RBI Act 1934. And one more important point that we should remember with respect to CRR point of view, RBI never pays any interest for banks on the CRR amount. This is all about cash reserve ratio, right? Next, coming to next, another indirect instrument, that is SLR. So what is SLR? This is also one of the direct instruments, or I can say reserve ratio. So what's actual abbreviation of SLR? It's statutory, right? Statutory liquidity ratio. SLR is nothing but statutory liquidity ratio, right? What is the definition of SLR? Again, it is some percentage of NDTL, that every commercial bank has to keep with themselves, within a bank itself. Previously, if I talk about CRO, in that case, banks have to park their money, their percentage of NDTL with their authority called RBI, that's CRO. Whereas in SLR point of view, not with their authority, they have to park with themselves only. But remember, it's again percentage of NDTL. And one important difference between CRO and SLR is, CRO, it should be in the form of liquid cash only, whereas SLR, it may be combination of cash, gold or government securities. Any of these three forms banks would like to keep within their pocket. That's actually SLR definition, right? And one more thing, remember again the numerical with respect to SLR point of view. Present SLR is this figure, 19%, and these figures are not constant. Based upon the economical factors, economical situations of the nation central bank, in our case it is RBI, our RBI, time to time they will change these numericals. So when they will change, so all the things again further discussion. It all depends upon this economical growth perspective point of view, inflation percentage point of view. All the things will comes into the factor, will comes into the action. Based upon that things, economical growth as well as inflation. Based upon those things, RBI will have a control over this SLR or LCR. These numbers will be changed from time to time. So with respect to that, I want to talk one particular word called bi-monthly policy. There is a word called bi-monthly policy. If I talk about a financial system, financial year, one financial year starts in April as of now in our nation, starts in April, 1st April, ends next year, 31st March. That's one financial year, right? Total 1st April of, let us assume this year, 1st April 2019, it ends next year, 31st March 2020. So this is one financial year in our nation as of now. So this nothing but simply combination of 12 months. I said one word here, bi-monthly policy. Means bi-monthly means for every 2 months. Bi-monthly for every 2 months, right? So total we have in our monetary policy topic point of view, we have total 6 bi-monthly policies. Every bi-monthly 2 months, na? So total how many? 6 bi-monthly policies. First bi-monthly policy starts first week of April. Next bi-monthly policy, April, May, it's already over on June 7th and 8th, this month itself. If you observe that, already there is a committee called MPC that I can say again further discussion, Monetary Policy Committee. So this committee is a combination of 6 people, 3 members from RBI, 3 members from Government of India, which includes RBI Governor also. Present guy, present RBI Governor, Shakti Kandas, if you all people remember that guy name. So simply 3 from Government of India, 3 from RBI. For this again there is some history is there. Some stories there why MPC came into the action. Before 2016 if you remember, there is no MPC committee. Whole powers under the hands of RBI Governor only. But something mismatch happened, misunderstanding happened with then RBI Governor Raghuram Govindarajan and then Prime Minister itself, that guy is Narendra Modi. So when they came into the power, lot of political reasons, whatever it may be, they introduced one bill itself in Parliament, that is MPC, Monetary Policy Committee. So a lot of history is there that I will discuss later, right? So simply remember, these committee members, these 6 people will meet for every, at least according to these committee rules and regulations in annum, at least they should meet 4 times. And yes, they are following this rule on every bi-monthly. That means April, first bi-monthly, June, second bi-monthly, June, July, August, September, October, like that. So overall, a financial year is a combination of 6 bi-monthly policies, right? So on that meeting of bi-monthly policy times, by considering a lot of factors, what is economical growth of our nation, what is the percentage of inflation right now in our nation, whether which is in controllable limit or not. So by considering these all factors, these figures, either CRO or SLR or else the things that I am going to discuss, repo, reverse repo, these all numericals, they will decide. And one important thing, people who are going to write these all bank examinations, these numbers also very important, like what is CRO, what is SLR, what is repo, reverse repo, MS of bank rate, all these things. And those figures are not constant, they will change from time to time. Just if you refer newspapers on 7th and 8th of this month, so there is a change of 25 basis points with respect to repo or else reverse repo, all these things. You may ask, what is the meaning of basis point? So first of all, these things clear, right? So 6 bi-monthly policies, all these things. In this bi-monthly policies only, they will change these numbers. Remember, at present SLR is 19%, CRR is 4%, and those two are percentage of NDTLs only, right? Now coming to this, just a small topic, just a small clarity that I want to give for you people. What is the meaning of BP? Basis points. Basis points. Basis points, right? As if I talk about simply 1 meter, you people will say 100 centimeters. 1 kilometer, you people will say 1000 meters. Not only me, if I say question to other guy, the same that guy also will say this numbers only, right? Why? This is the kind of reference universally we are accepting. 1 meter, 100 centimeters. If on the day when they define, if they say 1 meter is equal to some other name, we have to accept that. Right now, all following this kind of thing, the same manner in this financial system also, they define in such a manner that 1 basis point, 1 BP, 1 basis, BP nothing but here, basis point, is nothing but 0.01%. It means if I say 100 basis points, that means 1% now. right? So simply basis point is nothing but it's 0.01 percentage, 100 basis point equal to 1 percentage. And remember one thing, RBI will always speaks in a such a language that in this terminology only, basis points. Today we are going to hike repo rate by 25 basis points, or else by reduce by 25 basis points, like that. They will speak, they will communicate with the particular people technically with these terms only, basis points. But remember, 100 basis point nothing but 1 percentage. If I say one simple statement, upcoming bi-monthly policy, when if it is June 2nd bi-monthly policy, next bi-monthly policy, June, July, August. That's 2 months gap now. June it happened, which includes June and July. Next month, first week of August. If on the day, let us assume, on August 1st or 2nd week, if RBI, that is MPC committee says, we are going to hike SLR by 50 basis points. If they said like that, if MPC committee said like this, what it means? They are indirectly saying we are going to increase this basis, what we call SLR, by 0.5 percentage. 50 basis point nothing but 0.5 percentage. Understanding or not? So simply here, RBI will always speak in this language only. Remember that 100 basis point nothing but 1 percentage, right? So CRR clear, cash reserve ratio, SLR clear, statutory liquid ratio, and remember CRR banks have to keep in liquid form only, that too with their authority. Whereas SLR they have to keep within themselves, but it's their choice. They want to keep in cash form, they can. Gold form, they can. Or else government securities form, they can. Right. But many banks would like to keep their SLR in terms of government securities only rather than cash and gold. Because simply, let me take one example. The first example that I explained to you. Having 10 rupees in your pocket and you kept that 10 rupees in your home secretly, ideally, and you kept that in a locker and you locked that. You opened after 1 year. So is it that 10 rupee will become 11 rupee? Not at all, right? So that 10, that's an excess amount, let us assume that's a 10 rupee that you have excess amount. You want to generate the from the 10 rupee also some return. Yes or not? If you keep idly in your pocket, you can't generate any income. Instead of that, because of inflation, the purchasing power of currency today is not definitely equal to tomorrow. See, the cost of flat today in Bengaluru, I can say around 1 BHK around 40 lakhs, 2 BHK around like a 60 lakhs, like that. Can we guarantee after 10 years the same prices? No. The reason behind that, day by day, every day, currency losing its purchasing power because of inflation. If inflation is like around 3 to 4% in a nation like India, it means there is a growth of what we call a fixed assets value every year by that much percentage. At least, worst case I'm talking at least. It means today 1 crore house, after 10 years if I talk, it definitely 1 crore 30 lakhs if I take 3% inflation per annum. The same house today 1 crore, but after 10 years it will become maybe 1.5 crore or else 1 crore 30 lakhs, like that. So we people have to make our financial plannings in such a manner that you should make your investment plannings in such a manner that you should beat inflation. If not, you are behind inflation. If you are parking your funds in savings account, it's again just neutralizing impact of inflation. Having 1 lakh kept in an SBI account or else other bank account in savings account form, let us assume that 1 lakh today, whatever the purchasing power, after 1 year also same only. You may think I earn an interest of around 4% or 3.5%, but inflation also that much percentage. You should neutralize that impact first, then you should earn more than that. Then only you are ahead of inflation rather than falling behind inflation. This is again separate discussion called inflation topic that we will discuss in a separate time, right? But coming to this particular topic, so like CRR, SLR. So these two are direct instruments and I can call like a reserve ratios, right? And one more important direct instruments, that's refinance. Refinance. Reserve Bank of India will provide refinance facilities. There is a 2 kind of facilities, refinance facilities. First of all, the meaning of refinance. The meaning of refinance, don't think like a providing finance again. Not like that. The meaning of refinance is providing better terms and conditions, for an existing old debt. If you are a bank, let us assume I am RBI, you people are a banks. You people borrowed from me some whatever the rate of interest, and after some time I can again modify that agreement between you and me with the better terms and conditions. The better terms and conditions may be sometimes favorable to me, sometimes favorable to you. Understood or not? So simply refinance is nothing but replacement of old date or else past date with the better terms and conditions. That's nothing but refinance, right? And in this our discussion, Reserve Bank of India will provide refinance facilities for export credit according to section 17 subsection 3A of RBA Act 1934, and special refinance facility also there, that's especially for different kind of things, like according to section 3B, this is section 3A, section 17 subsection 3A, section 17 3B of same act, RBA Act 1934, right? And I forgot to say, the act of the section of SLR is, remember, so if I talk about even that sections also, let me list out. CRR, SLR, present value 4%, present value 19%. Remember, these all are percentage of NDTLs only. NDTLs. What is the meaning of NDTL? Net demand time liabilities. Net demand and time liabilities. Again, this is a further discussion that we will discuss later, right? One more thing. This should be kept in the form of cash with authority called RBA. These banks can keep it themselves, either gold form, cash form, or government securities form. With whom? With the bank itself, within their pocket itself. This is with the RBA, this is with themselves. Here, no interest. On CRR, RBA never pays any interest. Whereas here, banks will generate some income from this SLR money also, either by investing in government securities or by investing gold. Because this gold is not a stable value. Today it may be per gram 3000, tomorrow it may be 3200, day after tomorrow it may be 2800. There is no guarantee. So that's why, again, the further banks would like to keep this is rather than gold form in government securities form. From these government securities, they could generate some income from SLR also even. But it's very small amount. But yes, something is better than nothing. So in that principle, they would like to keep their SLR amount in the form of government securities. And one more thing, CRR has mentioned under section 42 subsection 1 of RBA Act 1934, whereas SLR, remember, it has mentioned under section 24 of RBA Act, sorry, it's not RBA, it's BR Act, that is Banking Regulation Act 1949. Remember, here it is RBA Act, that is CRR, but SLR it is BR Act 1949, section number 24, like that. Whereas refinance, that's a separate thing, but also it's a part of direct instruments only. RBI will provide refinance facilities for banks as well as export credit purpose point of view to